All right, folks, we're going to go ahead and get going. My name is Gene Jones. I'm with the Southern Waste Information Exchange. Welcome to the 39th Southeast Recycling Conference. We are recording this session. In fact, all the sessions are being recorded via Zoom. Welcome, virtual attendees. Before we get going, I'm going to hold my opening comments until tomorrow morning, but I'm going to ask everybody, if you would, put your cell phones on vibrate. And I am going to turn this over to Mark Neitzey with Van Dyke. So he is going to moderate our program and get us going. All the presentations that you're going to we'll see over the next day and a half, 2 days. We're going to shoot to PDF and send them out to everybody, as well as the recordings. We'll send those out probably towards the end of next week. So Mark, all yours.
Hey, good afternoon, everybody. I'm going to moderate today's session, which is EPR, Capital, and Markets, the Forces Reshaping U.S. Recycling in 2026. Without further ado, we're going to have Jason Bergquist, CEO of RecyleMe, come up and give a presentation entitled Critical EPR Developments Shaping the U.S. Landscape. Take it away, Jason.
Not used to applause. And you know, the weird thing is, if I had my choice between sitting outside by the pool with a beautiful ocean or sitting inside hearing about EPR on a Sunday afternoon, I'd be here too. So we got that in common. So I've got a presentation here on EPR in the U.S. It is akin to skipping a rock across the pond. We can't go too deep anywhere if you want me to get to the end of it. So I'm going to go fast, but as was said, these presentations is obviously shareable, and you can also reach out to me directly if you've got any questions. So, RecyleMe, just very quickly, we're the consulting division of the RAND group of companies. That's RAAN, based out of Germany. We've been there close to 30 years. EPR for packaging has been in Germany, or in Europe, I should say, for close to 30 years. So we do consulting with brands on the EPR compliance strategies. We also run 10 of the producer responsibility organizations in Europe. It's a competitive landscape there, so we do the operational side as well. We then have been in Canada for close to 18 years. EPR for packaging has been in Canada for close to 18 years. And same division of the company. We do consulting, but then also operate 2 of the pros there. One, actually, we run the bottle bill program out of Manitoba, and then the tire recycling program, one of them out of Ontario. We then launched in the U.S. At the end of 24, and then last year took the 2 divisions of the company in North America and brought them together as one. So we're doing North America consulting services for our clients. Because as much as there are many, many differences between the regulations in Canada and the U.S., if you're a multinational brand, you kind of still want one-stop shopping. We're able to do a lot of the sort of the heavy lifting, the data work, et cetera, applies to both countries, right? So that's who we are. Okay, I have to do my legalese here. I'll back off a little bit. The landscape of EPR in the United States is moving very, very quickly. So I literally could have something on the slide deck that I sent here last week that's already out of date. This is also not legal advice. It's just sort of general overview. And then you'll also, if any of you have had the pleasure of sitting through Circular Action Alliance webinars, you may recognize some of the content, but they are the pro of record for 4 of the 7 states. And so, you know, it's a source of truth for some of this stuff, so we clip from them. We're not paid by them. We don't speak on behalf of them, but okay. All right, so here we are, 2026. Year 2, really, when we're looking at EPR in the U.S., the second year with obligations for obligated producers. We have 7 states now with active EPR for packaging rules in place. We've got the original 3 that we'll touch on, of course, Oregon, Colorado, and California. And then we've got 4 more that will likely have some requirements for obligated producers this year. And that, of course, is Maine, Maryland, Minnesota, and Washington State. In addition to those 7, we have 3 others that have passed needs assessment phases. Now, not all states do this first. It's kind of a logical thing to do. You go in first, determine what kind of you're trying to solve for at each state at the recycling infrastructure level. Again, some states don't do that, but if one does do that, likely EPR for packaging regulations will follow. And so we've got Illinois, Hawaii, and Rhode Island have passed needs assessment phases. And then we've got 10 more, plus or minus at any given day. We'll touch on these at the end of the presentation that have some form or another of EPR regulation at some stage in the legislative process. Now, one of the things that's happening is there is a bit of a stall right now, I would say, a pause. Anytime I talk to anyone at the state level that is working on some form of legislation, they're watching California right now. We're going to talk about California. It has now been pulled back 3 times, even though there has been obligation actions required for obligated producers. So it's one of these things where it is obviously a very critical state. As EPR regulation passes, the 4th largest economy in the world, all eyes are on it right now. So I'm not going to go into this at a micro level. Again, you can get this presentation. The point of the story here is we've got 7 states that have passed. Yes, they all have packaging in their covered material category list because it's EPR for packaging. But you spend 5 minutes looking at this matrix, you can see we have 7 states with a whole lot of differences, with a whole lot of areas where there is non-harmonization going from state to state to state. This makes obligation, this makes compliance by brands extremely challenging in these early years. And I'll touch on this a bit more. But as we go across that sort of second row there, even looking at covered materials, we have within those 7 states a couple that have bottle bills. In a state that has a bottle bill, any kind of beverage container, the aluminum, the PET, the glass is excluded from the EPR for packaging. But you're not completely off the hook, because if there's presentation, if there's secondary packaging around that, think the cardboard case around a 12-pack of beer, that gets included in the EPR for packaging regulation. So as a beverage producers, you've got now 2 compliance mechanisms that you have to be paying attention to. We've got different levels of scope here. We've got states like Oregon and California, huge scope. In Europe and Canada, what they call it is pulling in IC&I, right? Institutional, commercial, industrial, sorry, did it in the wrong order. But that kind of is unique for EPR. Most EPR schemes don't include business to business. They really are focused on business to consumer, like Colorado did. In the early years, the Colorado very much focused on what a customer walks out of the front of the store with in their hands, what a customer receives in the mail through e-commerce, business to consumer there. And then we've got different levels of funding, which at a conference like this gets really important. I'm not going to dig into how the programs are actually operating at this point. It's very early. Oregon's the first one, and now Colorado, they're actually doing this second half. They've collected the money. Now they're in the middle of starting to spend it. So that'll be next year's presentation. Basic tenets of EPR for packaging here. Again, where you see is more similarities here as far as the structure of it, but still some differences, still some challenges as far as if you're a brand trying to comply with this. I live in Maine, so I can talk badly about them here, but they have a different process there. It's called a stewardship organization, not a producer responsibility organization. Very much government directed, municipally driven. It's a little different from how anything else is done typically across the EPR landscape. So just sort of quick overview of where we are in those initial 3 states. Oregon, not the first state to pass the regulation, but the first state to have a fully signed off, implemented program. As I said, Circular Action Alliance, the Producer Responsibility Organization of Record, they are now in the process of sort of phase 2, which is they've got the money, they've invoiced twice now, one for a half year for the first year of the program, and then brands just received their second invoice to cover a full year. So they're collecting the funds and now implementing the back half of this process, which is determining how the money will be spent to improve the recycling infrastructure there, right? They're going to have to report on this. We get asked about this a lot. Yes, they will be held accountable for how that money is spent. They have, particularly in Oregon and California, they've got some pretty significant benchmarks they have to hit to demonstrate that the program is actually effective. There's quite a bit of burden on them now at this point. They have now started what they call the enforcement phase. There was a 90-day waiting period that is now over, so they are reaching out to recalcitrant producers. What they're doing is the first round is they're starting with folks that registered but didn't report because they've got a list. A little backwards there, but anyways, that's where they're starting. So there are brands out there that did register but not report, or are getting letters saying, hey, you got to report. And then the second phase will happen. One of the enforcement mechanisms in place for both Oregon and Colorado is the list of registered producers have been published and will be updated. So the idea here is if I'm a brand who did comply, who reported, and I take a look at that list and I see a competitor who's not done it, I am encouraged as a brand to let them know about that, So there is sort of a public-facing side of enforcement here, and then we fully expect further states to adopt that methodology as well. The big news in Oregon that many of you probably are aware of is this is the first lawsuit filed against EPR. First state to pass it or to have a fully signed off program, first state to have a lawsuit. So the National Association of Warehouses filed an injunction. It was on February 9th. It was seen, and it is now, the courts are going to, I think they're going to be hearing in July 13th, I believe is when the trial starts. But if you are a member of NAW, you don't have to comply until this injunction is decided one way or the other. Now, you can't sign up now, so you had to be a member of NAW when the lawsuit was filed. But this is the first time. This is testing the, sort of the edges of EPR for packaging regulation. One of the claims is interference of interstate commerce. That was kind of an obvious, expected one that was going to be there. Another one is giving a non-governmental entity, in other words, Circular Action Alliance, authority to run this program. So there's a couple pieces in here that we're all going to be paying very close attention to. Unfortunately, I don't think it's going to be the first lawsuit that comes down the pike, especially once California finally does get signed off, but it's the one we're paying attention to because it will set some precedents for how EPR for packaging is rolled out in the rest of the states. Colorado is actually pretty straightforward. So they now have a fully approved plan, happened December 9th, so that's the second state to have it fully signed off. As I said, from a regulatory standpoint, from a producer obligation standpoint, much more simple than Oregon and California in that it's focused just primarily on consumers. This is sort of what EPR tends to look like if you look at the European standards, particularly if you look at the Canadian standards, where for the most part, no industrial, no commercial, no institutional is pulled into the scope. The other interesting thing is in Colorado is there is the first, I want to almost say a sub-pro that has been authorized by CAA there, and that is, I'm going to get this name wrong, it's the Petroleum Manufacturers and Packaging Association, I believe. They have been approved to operate a pro under kind of the umbrella of Circular Action Alliance just for packaging associated with oil, antifreeze, those kind of things. So this is sort of a semi-version of what happens in Europe. It's not competitive necessarily, but there are a lot of advantages to having industry-specific pros. And so, again, this is kind of a big deal. Everyone's paying attention to this. Believe they're in the middle of negotiating on the Oregon side as well. So I think we'll see more of these kind of under pros get developed as we move forward. And then California. So a lot to talk about here. Huge scope. One of the things I'll talk about in a second, or I have been talking about, but we'll repeat, is this lack of harmonization. No wider scope than the one in California. California even pulls in pallets. Now, if you think about really what the focus typically is for EPR for packaging, it is material that enters the residential recycling stream. And so when you're talking pallets, one of the most, recycled things we've got as far as how things are shipped and moved around in this country, the fact they're trying to pull this into the scope is just an example of how really wide and overreaching the scope of the California regulation is. So it keeps getting put out, pulled back, put out, pulled back. It's in the middle of a public comment period. One of the things that's really, there's a lot of controversy, a lot of debate happening right now is over how much flexible plastic packaging will get pulled into the scope here. The second go around, most of it was eliminated. One of the driving forces there was saying that if it was packaging required by FDA or USDA to protect the health of the consumer, it would not be pulled into the EPR for packaging scheme. So, and this is again being revised, but at that time, good news if you're a flex film producer, bad news for everyone else because the budgetary target remains unchanged. And so if you exclude 25, 30, 40% of the potentially obligated producers from the scope, those remaining just have bigger tranches to pay for. So that's kind of where the push and pull is happening with this. Again, when I say all eyes are on California, this is an example of that. It also reaches into, this is more common, into over-the-counter pharmaceuticals. So pharmaceuticals not requiring prescription, they're pulling some of this in, which would mean, the tamper-resistant foil on your aspirin, that kind of stuff. The argument is that shouldn't be required because it's for the protection of the consumer. We'll see how this plays out. So, I've touched on a couple of these already. the differences in scope, the differences in whether or not it's going to be business to consumer or business to business, bottleable versus non-bottleable, those challenges. Again, when is a package a package? Oregon, for instance, pulled in trash bags. So if the intent of the program is to focus on material, packaging material that enters the residential recycling, waste stream, hard to understand why they would pull in garbage bags. It was a massive bill for a couple of those companies that you can think of at the top of your head that produce garbage bags. And the argument there was, well, sometimes people use them for storage. Okay. Really extreme as far as pulling that into scope there. We've got, when it came down to sort of the 11th hour for both Oregon and California, or Colorado, we had these 11th hour decisions about when is a package, when is it not a package. So the definition of design to protect, or package the material there within, okay, fine. But then they sort of came out towards the end and said, well, if by removal of the package you render the material inside unusable, we're not going to call it a package. This excluded the plastic on all disposable lighters, the plastic tubes around ink pens, cut it out of scope. Now, we've got clients that are in the cosmetics industry who have eyeliner, chapstick, lipstick, all of these things that have tubes that if you remove them would render the contents inside unusable that were included in scope. So these are some of these tricky areas, these gray areas, potentially not always fair areas that come when it actually comes time for the rubber to hit the road in the implementation of these regulations. So again, could go on and on with examples that we had to work through last year and we'll be working through this year on this kind of thing. But moral of the story, point of the story, 7 states, each with different definitions about who a producer is, although Maryland, along with some others, are coming into line about that. But different covered material category lists. For instance, Oregon and Colorado, 67 categories. California's got 98 categories. Different fee structures, different eco-modulation programs, and that's just 7 states. Again, with 3 more that are taking the first step, 10 more behind that. Okay, so, a huge complaint last year was about this lack of harmonization. And so what Circular Action Alliance has tried to do is introduce some harmonization. Again, at the state level, those second 4 states have got together and are aligning that definition of producer. So that's good news. Another piece of good news is in this effort to harmonize, at least the data years that are being pulled are being harmonized. Last year, we were reporting 2024 data for Oregon and Colorado, 2023 data for California. In this case, for proposals that everyone's going to be reporting on their sales from 2025. So that's good news. We've got repeated full program reporting for those first 3 states, and then what's being called simplified pre-program reporting for the second 4 states. The challenging news, I don't want to say bad news, it's kind of bad news, is they're proposing all of this gets reported on May 31st. So despite everything I just said about all these differences, all the challenges, the idea here in an effort to harmonize is to have everyone report on May 31st. Now, this isn't a new idea. This is exactly how it works in Canada. But Canada's had EPR for 18 years. The covered material category list, the definitions of who an obligated producer is, why they have differences are much, much more in line than anything like we have here. So this is going to be an extremely heavy lift to get all this pulled together. And if you noticed in an earlier slide, the number of registered producers in Oregon was 3,300. In California, even though it was a little fuzzy as to whether or not you actually had a report in November, there was 1,800. So, what was that? Oh, oh, that was a response. That was good. So, again, 4th or 5th largest economy in the world, 1,800 producers registered. I'm guessing some folks are missing. Now, there are a lot out there that are still coming to understand this. We do have clients that are coming to us, just this month saying, hey, we didn't know we were supposed to report. But there are also brands out there sitting back and waiting. Because again, to date, no enforcement action has been taken. To date, California doesn't have anything, close to a signed off set of regulations, even though they're saying they're holding to the dates that are required for reporting. So, again, this is more when I do presentations for the brands. The invoicing is really confusing, so we take a minute to walk through this. I won't do that here, but if you're interested, this is how the invoices are going to get rolled out. So California, again, this could be a whole hour presentation. I'm not going to do this, but I just want to cover this because, again, it is the EPR program that everyone's paying attention to. So despite the fact it's been pulled back now 3 times, it has, without argument, some of the most ambitious/aggressive goals of any EPR state in the U.S. and arguably globally. PPWR in Europe is going to be probably even more ambitious than this, but it's not in play yet, and it's potentially going to get slowed down a bit. There's Federal Plastics Registry, FPR, in Canada, which has a component that is challenging like California's to come to plastic. But as far as these goals and impacting a lot of the folks in the room, because this is what the infrastructure is going to have to demonstrate that they're pulling off, we've got by 2032 that 100% of the packaging in the state will either be, according to California's definition, recyclable or compostable. There are companion bills to this. One is this truth in labeling bill. You can't just call something recycling. You have to prove it per California standards that it's recyclable and or compostable. That 65% of all single-use plastic will be recycled. So once the program's in place, this is Circular Action Alliance, and this is all of the municipal and private waste haulers, recyclers, having to demonstrate that, in fact, these goals are being met. That by 2032, there's a 25% reduction in plastic packaging by weight or volume. Now, it's a bottle state, so PET bottles aren't included, but I just want you to sort of think about this for a second. With all this focus on plastic, we all know what happens with most water bottles now. If you take the lid off and squeeze too hard, you've got a fountain. So thinking about actually lightweighting that by 25%, thinking about lightweighting stretch film by 25% and still having it do its job, if you think about all these pieces, you start to really sort of understand the challenges here. And by the way, there are tiers along the way. Not running down your face, although those happen too. But you have to meet goals, every couple of years to show your achievement towards this. And then on top of this, in addition to the covered material category fees, payment into a $5 billion, I'm not misspeaking there, pollution mitigation fund, focused on plastic. So there are a lot of folks out there that are calling this not EPR, they're calling it a pollution mechanism, pollution prevention mechanism. And there's logic to that. There's logic to that. You saw on the original matrix slide, like I said, I'm going to go faster because I also don't want to chew up everyone else's time, that, sort of the items that are pulled into there. Again, in California, everything is pulled in, including pallets, right? Secondary packaging, tertiary packaging, all of it is in there. Those are those tiered goals I talked about. And then one of the things that I mentioned in sort of tying into the Federal Plastic Registry is in California, not only are you reporting the weights into each of those 98 categories, but you're also having to break down any piece of plastic or plastic form or multi-layer component if it's over 2 inches and count it. You're reporting on the number of pieces of plastic that are entering the state as part of your reporting. I'll show you a screenshot of that here in a second. So this is the whole decision path as to how you go about reporting all these pieces. If glue has enough, quote, plastic in it, you're reporting on that. If it has impact to the weight, you have to report on that. It's very, very extreme. This is what the actual list looks like. As I said, they've got 98 different categories, a third of which are similar to this page, are sort of individual types of plastic component, resin breakdowns, that kind of thing. When it comes to actually doing the reporting, every piece has to be reported separately, as I said. So you've got our fancy spicy salsa jar here on the left. That's kind of more easy to wrap your head around. The cap is going to be reported differently. The label is going to be reported differently, and the glass jar. But then if you look to the right to this aerosol can, whether it's metal or plastic, almost doesn't matter. Every single detachable piece in there will have to be reported. You get a little break in that the nozzle mechanism, because it's all put together, it's a mechanism, that'll count as one piece, and you're going to be reporting on the main material in it. But then every other component that's got to be broken down and reported separately. This is what the nice, easy portal report looks like. So as I said, you've got all those categories and you're entering the weight on it. You have to check and make sure and verify that if you're calling it recyclable, that it matches California's definition of what recyclable is, as I said, or compostable. It's a little unique in that they do have an alternate path to hitting those goals to compostability. And then again, the number of actual individual plastic components. Okay. So Maine is next. Now I say next, it was actually the first state to pass EPR, and it still hasn't actually got its act in gear. So as I said, the scope is fairly similar to many of the other states, There is some business to business included, but only if a customer can walk out of the front of the store with it. And so this really is something like, the Costco example, right? So you're buying food in bulk. It comes in a cardboard tray with shrink wrap over it, just like a store would receive it when they're ordering in bulk. If I as a customer can walk out of the store with that level of packaging will be included. And it's got some of the similar medical exemptions that we talked about. But other than that, it's a very unique program that is municipally driven, municipally funded. There are no producers involved in the program. It is a non-producer involved program. And that is one of those things that really bucks the trend. EPR everywhere else in the world where it has successfully been implemented, typically, not always, but typically involves producers. And we see that with Circular Action Alliance. They've got a board. All these brands you know and love are part of that, helping drive the policy so that it's something that makes some sense. With Maine, they're not doing that. No producers were invited into the process. Similar targets to Colorado, really, as far as what they want to achieve. But, what I wanted to point out is, again, first state to pass it, but it's been pulled back a number of times. And at this point, there was supposed to have been an RFP issued for whoever the sustainability organization, the SO, is going to be by fall of last year. Didn't happen. Keeps getting punted down the field. So this is one of the states when we're looking at a May 31st reporting deadline. It's difficult to think that would actually happen at this point. Because the SO was supposed to be selected by spring, again, and the RFP hasn't even come out yet. And then again, they were expecting to have producers paying fees by mid-year. So we'll see. We're keeping eyes on this. Okay, so last but not least, this is the crystal ball that is almost always wrong, but we do pay attention to this stuff, try and help our clients sort of see down the road a bit. One of the first states that we anticipate, it keeps getting close, is Massachusetts. One of the things we see is that you have almost clusters, right? So if there are a group of states that have EPR, then the ones around them tend to be the next ones to pass. If you look at the Northeast or the Northwest, that's kind of how it's gone down. You got Washington State being added to Oregon and California, obviously. And then in the Northeast, you've got traction. You've got Maine, and then we think Massachusetts is one of those ones likely to come next. I would say even more likely would be New York. New York keeps getting really close. Now, they've got alternate bills that compete with each other, so that slows things down a bit, but it's very, very likely that potentially even this year they'll pass. One of the slightly worrisome things, and I know I'm doing a lot of editorial here, but is there is discussion they may try and mirror some of California's pieces, components of their program. So as a brand, you put those two states together, it's 1 out of every 8 consumers. The financial repercussions could be quite significant there if it does mirror California in any kind of material way. Again, New Jersey is another Northeast state that keeps getting very, very close. Rhode Island is working on a combined, we were talking just Angie and I quickly before about this approach, but a combined bottle bill and EPR for packaging bill. I understand it, that's a lot to pull off. I've worked in bottle bill in the past. I ran one of the bottle bill programs in Maine and New York. It is just like EPR for packaging. It's a beast to run and do well. One of the arguments for having the two run in parallel is, and I don't know if Miles Cohen is here. Last year we had a bit of a debate about this. The theory is the PET, the aluminum, the glass comes out cleaner when it's segregated through a bottle bill program than if it's pulled into the entirety of an EPR for packaging. That's the theory. I'm not going to weigh in either way because that'll get yelled at. But that's part of the thinking behind a combined strategy like that. Both Connecticut and Hawaii have needs assessment phases passed. I think I said it wrong at the beginning. It's Connecticut. Illinois does as well, but Illinois is really slowing down. So we actually sort of dropped it off our watch list as far as the state. I don't know if there's anyone here from Illinois that wants to argue with me, but we've dropped it off our watch list as far as states that have potential to get over the finish line this year. And then New Hampshire just passed. Again, if you look at these clusters, we see another New England state working on pushing through EPR. I don't have it on here, but one of the really interesting ones to watch is Tennessee. It's the one red state, not the politics come into play here, but the one red state with EPR for packaging, and they've got a really, I think, nice bill called Waste for Jobs that's getting really, really close. Just barely made it passing last year, and it's going to be reintroduced this year. Okay, last one I'll go, and I'll skip over the next one here. This is year 2, and so one of the things we're working with our brands on is now fee mitigation. And so, it's really sort of working with them now that they have an idea what the fees are going to look like, what the costs are going to look like. working with our clients to say, okay, there's two sort of main ways that you can look at your fee mitigation strategies. The first is to work that covered material category list. There is no state that doesn't have polystyrene at the top of the list as far as fees go. So if you're someone for electronics manufacturer, for instance, and you can swap out the styrofoam for some other kind of dunnage inside that package, that's an easy win. And then there's the second phase, is eco-modulation, which is every state's going to have a form of bonusing those who do things, make changes in their packaging, et cetera, to make it more sustainable, to have a less of an impact on the recycling stream. And then malice, fine them, raise, penalize, whatever you want to say, raise the rates for not doing that. So those are two ways that now that we're into the second year, that we're able to work on. Now we know what it looks like, kind of. There's a lot more to come, but we can start working on ways to lower those fees. Do the right thing, comply with the law, but pay a little less. So again, this is really brand focused, so I'm going to skip that. All right? So I think we'll have a little time for Q&A at the end, but yeah.
As Jason mentioned, we will take questions at the end for all three panelists. All right, next up we have Ray Hugel. He's the Director of Closed Loop Partners. He's going to speak of financing circularity in a challenging climate, innovative sources of capital for circular solutions. Take it away.
Let's see if this works here with my notes. Wonderful. All righty. Well, good afternoon, everyone. Thanks for having me. It's nice to be at my first SERC and out of the cold weather of the Northeast. We were celebrating that was above freezing for the first time in about 2 months this weekend. So even the 65-degree weather is a plus. For this pre-conference workshop to kick things off, a little learning and development. Kind of excited to be in the middle seat on this panel between EPR policy and commodity markets, which are kind of two forces that really impact the investment making decision, which I think about a lot. This presentation, I'm going to give you some insights on just how a financing provider thinks about investing in the sector and what I'm seeing out there. And really an alternative title from this long-winded one on the screen is more, I have a recycling project and what do I need to know and to pay for it. So diving in, going to cover three main categories here. What are the key drivers of that investment decision-making process, kind of what's going on a macroeconomic level, and then more granularly, what does an investor look for in these projects? What are the funding options available? And then, one of those funding options, something I think about a lot, is catalytic capital and how that can be used as part of an overall capital stack to ensure long-term project success. Similarly, I do need to do some disclosures. I do work for an SEC-regulated entity. So real quick, presentation is for information purposes only. Nothing here is a solicitation to sell or purchase securities. That's a very important one. Not investment advice. If you have your Robinhood or Fidelity account opened, I'm not going to make any stock recommendations. I'm a private market investor, and past performance is not indicative of future results. So with that out of the way, just a bit about me and my background. So I co-lead Closed Loop Partners, Catalytic Capital, and Private Credit team, which is part of our capital management division. You can see my contact info on the right there. I spent the first 10 years of my career on Wall Street financing a whole different slew of asset classes, from the mortgage industry to solar to energy efficiency. I moved over to Closed Loop Partners about 4 years ago, where I have a lot of creativity and flexibility to deploy capital to the circular economy. You can see at the bottom a number of different transactions that I've worked on, across equipment finance, infrastructure builds, working capital, and growth projects. LRS's large shiny MRF in downtown Chicago, Kansas City when they rolled out 162,000 recycling carts to their citizens, Gray Parrot, a data analysis company utilizing AI to track data in recycling streams, Superior Fine Grind, one we did last year, a smaller scale MRF in PA, and then right next door, ECUA, a number of years ago when they took the initiative, bring in new technology to their MRF and installed, I believe it was 8 amp robots, a first mover of that. We helped scale and test out that new technology for them. A little bit about Closed Loop Partners. It's a firm focused on building the circular economy based out of New York City, founded about 12 years ago. For us, we believe a more circular system is a more economically beneficial system, that we are continuously putting in valuable materials into landfill, and we can extract that valuable material and keep it in circulation, limiting natural resource extraction at the same time. We aim to achieve that goal with our 3 operating divisions: our Innovation Center, the Center for the Circular Economy; our capital management arm, where I sit, which also has early stage venture investing and private equity investing; and then our operating entity, Closed Loop Builders, of which many are probably aware of our brand, Circular Services. And you'll just see, over our history, we've made over 100 investments globally. We manage close to $600 million, and we've kept over 16 billion pounds of material in circulation through those investments. So let's get into it. The first kind of main topic here are key investment drivers or current state of affairs, what's going on in the world. And really, why are we here and why does this all matter? And it's really pretty much recycling infrastructure is pretty critical to society, and we need to continue building and scaling and optimizing the recycling system to ensure its overall success. And that means for us, building the entire value chain from collection, sortation, processing to end manufacturing. And, key themes of why does this matter is those capital projects, they're becoming more expensive. Part of that is technology is advancing quickly, but on the flip side, positives are tailwinds that support scaling that infrastructure, and with the right access to capital, you can really be successful in those projects. So maybe just some key broad macroeconomic themes to run through. A lot of these touch upon all different sectors across the economy, not just the recycling industry, but I'll kind of double click in its impact for us here at SERC. So inflation, still a big one, and increasing project costs. This sector isn't immune to that. I just pulled some kind of random headlines I've seen over the past year or so to highlight these projects are getting more expensive. Portsmouth, Virginia, putting in a $200 million plant, AI-powered. Waste management, a new $88 million facility in the Tampa area that follows a $30 million investment here in Fort Walton Beach about a year and a half ago, opening a new MRF. And then even Providence, Rhode Island, a cart rollout costing them $11 million. This is all important because it impacts that investment decision and what that right mix of capital is. Because at the end of the day, without changing your economics on the underlying projects, you kind of get capped on how much you can earn and what that means in terms of, say, debt repayment. I was looking into it. Maybe let's run through a quick example. The new Fort Walton Beach MRF, $30 million price tag. Probably want to finance that with some mix of cash and debt. And let's say it's $20 million worth of debt. The article mentioned 76,000 tons per year of processing capacity. Well, is it hitting 76,000? I don't know. Maybe let's say 70,000. Keep the math easy. Between the average commodity value and maybe a tip fee, all in $200 combined, you're looking at about $14 million per year on how much that MRF can earn. Now, a good MRF probably is hitting margins of about 20% EBITDA margins. Waste management, waste connections overall across their financials are a little higher. They've got a lot of economies of scale. They're at about 30%. But, let's just say it's an average operator hitting 20% margins on that 14 million. Well, that's $2.8 million of EBITDA per year. And so that, if you're doing $20 million of debt, and I did the quick math, waste management borrows around 5% in the markets over a 10-year loan, they pay back maybe around $28 million. Well, over 10 years, that's $2.8 million per year, and that kind of eats up all of your EBITDA. That doesn't leave a lot of room for cash towards other capital projects. So as projects get more expensive, you're going to need to change the mix of how much cash you're paying or how much you're charging to your local municipality as a tip fee or your other customers as a tip fee, or you're changing your revenue share. So we keep a big focus on project costs. Angie's going to talk a lot about commodity pricing, so won't speak too much to that, but we've been in this depressed environment for a while, and that's hurting bottom lines of MRFs. Interest rates, they continue to be elevated, even though the Fed has cut a couple times. They're still up there. Generally, tight budgets and long procurement cycles also impact projects, and the sector, again, not immune to artificial intelligence and novel technology, and tariffs and general economic growth all impact it. Tailwinds, on the other hand, why capital is still flowing? Well, domestic manufacturing and supply chain resilience are two key themes that are seeing a lot of investment across the country. And we just heard EPR policies, recycled content mandates will continue to drive investment. And generally, there is still demand from corporations and consumers to be end users of recycled material. So I have a couple charts here. I'm not going to bore you with a lot of them, but I like to just wanted to pick a few to narrow in on some of those data points, because I'm sure a lot of people hear about inflation all the time in news headlines, and maybe they see it at the gas pump, in the grocery store, their utility bill. The good news is it's kind of come down a little bit. It's been hanging around, between 2% and 3% for some time now, which is much lower than that COVID spike starting in 2021. But I think it's important to highlight, while that rate has come down, it's still above zero, which means prices still go up. So they're at this elevated level, but they're still going up. We're getting very close to that 2%, Fed target rate, which is like the nice sweet spot that's not as high as economic growth, GDP growth targets, but still allows for general growth of the economy. So actually a pretty good trend there. And then, we'll look at interest rates as well, another big metric that's been in the news a lot. So this is the last 10 years of the prime rate, which is 3% higher than the Fed funds rate. And it's a metric that a lot of local banks use to price debt. So if you have a project, you go to your local bank, they'll probably say, yeah, I'll charge you prime, maybe prime minus 50, prime plus 1%. But it's a good proxy for general borrowing rates. You'll see here, I said they're still elevated. It's been tracking the Fed funds rate, which it's set up to do. But what the bank adds on top as a spread, may have been a little more sticky or has widened a little bit. Now, at a federal level, there's been a push to lower rates. And although the Fed has cut, a couple times now over the last year and a half, they may be cutting further. I might be in the camp of maybe a little higher for longer, because if we zoom out over the last 50 years, we're actually kind of right on that long run average of interest rates. So people over the last decade kind of got used to that 3% mortgage rate and just generally the 0% interest rate environment following the global financial crisis. But we've kind of settled in at close to the historical average. So that's the macro perspective. To kind of zoom in on what are investors thinking of on a more granular basis, 5 key categories here on the screen are what I think about every time a new project hits my desk. And that's, financial strength, when a project becomes operational, path towards profitability, feedstock offtake security, and management and operations track record. Anytime a new project comes in, I'm usually asking for things like a project pro forma, a Gantt chart, who are the key contracts, what are the stickiness of those contracts, are there any key partners? Because we like to see, from a financial strength perspective, skin in the game. Let's think about it as your down payment on a project. Are you putting in any cash, or is it just going to be my capital as an investor? Do you have other debt at the table, and what does the analysis look like for an overall ability to repay? And then what will this project actually help unlock? Will a new optical sorter lead to X amount of additional revenue or EBITDA or net income, and therefore it makes overall economic sense? And then on the downside case, what is the value of assets and that collateral? I'm a credit investor by trade. I'm always thinking about the downside, and I always think about what the general market looks like for used equipment. If you've seen in the market, processors of plastics, there's been a lot of closures over the past 12 to 18 months. The buyer base of those has kind of shrunk, so it will take a lot to support another project, because in that downside case, there's even fewer buyers of that equipment. So what may have been, if I'm selling it, maybe it's worth 50 cents on the dollar, maybe it's 40 or 30 because there's 2 or 3 operators left who are licking their lips for a sweet deal. When the project will become operational, another important one, I've seen many projects kind of sit in permitting purgatory, just waiting on that permit to come through while they're paying property taxes and salaries, and their cash base continues to shrink. And also just generally, who else needs to sign off on that project? We work a lot with municipalities who typically need to pass ordinances for new projects. And so, we like to know what that timeline looks like. I mentioned profitability. The other downside case there, or the break-even rate, is what's the minimum amount of volume needed to sustain that project? And management and operations track record at the bottom. Will this person be a long-term partner? When things get tough, are they going to come to the table to work with us, or are they going to stop answering my phone calls? I've experienced both. So with the field laid out there of what I think about and what the economy looks like, really, what are those funding options available for your capital project? And so I have just on the screen what I see as the universe of how you pay for something, where you have cash, free money, strategic capital, equity, and debt, all with their pros and cons, which I'll get into. But I think they're all generally straightforward. Cash, what you have in the bank, or in your budget for the year, or in your strategic reserves that can go pay for your project. What I call free money, grants and donations. So things sources of capital you don't need to pay back. Strategic capital, kind of a catch-all category that could look like a number of different forms. It's partnering with maybe upstream and downstream partners that are maybe prepaying for sales, giving you money now so you can get your project up and running, expecting some sort of volume of product on the back end. It could be funding specific pieces of equipment, which a lot of brokerage firms may do. They may say, hey, I'll buy a new optical for you, but I need your brokerage business for the next X amount of years. Could be some other form of JV arrangement where you're contributing land, a building, maybe know-how, and somebody else is contributing equipment. Equity is selling a portion of your business to outside investors. So someone coming in, maybe they're being a silent partner, an active partner, but you're trading your business for capital. And then debt also comes in one of hundreds of different forms, but typically loans and leases, bonds, especially for corporations and municipalities, and even just lines of credit are 4 broad categories there. What do you need to consider between these 5 different options, and what are those pros and cons? With cash, it's what else can you use that cash for? Is it a rainy day fund? Can you use it for a different project? Could you invest it if you can get a cheaper rate on your debt? Grants and donations, a big holdup there typically is reporting requirements, and do you have a big enough team to address those reporting requirements? Is it cash up front, or is it on a reimbursement basis, and therefore you need to figure out the cash picture? Strategic capital, will that partner, will they be a good long-term partner, or could they potentially limit future opportunities if it stops you from partnering with or selling to a competitor? And really, when it comes into these very customized solutions, it's hard to figure out the all-in return. So if you agree to maybe provide some product for X price now, is that really at a discount that could look like 10, 20% if you were up and running? On the equity side, again, it's, can this partner help me scale? And how much control am I giving up? And do I have the valuation of my business correct? And on debt, it's, can I contractually commit to repaying this investment? Are the terms flexible and accommodative enough, including, reporting and any financial covenants? What is the recourse in terms of security and liens on my assets? And any maybe potential personal guarantees you have to give up. Overall, though, it's going to take a mix of these different categories for a successful project. And also, partnership's a two-way street. You should be talking with your the folks on the other side of the table to hear from them. If they're an equity provider, well, how much follow-on equity can they provide? If they're a debt provider, ask them, how have you handled stress situations before? Are you amenable to amendments in the future? And how strict are you going to be on financial covenants? And if I don't meet them? So those are the sources of capital, and I'll just get into kind of one type, which is Catalytic capital, which is what I do at Closed Loop Partners, and it's a mix of equity and debt, but really it prioritizes, some end goal, end financial return with the goal of de-risking projects and being a patient capital provider to encourage others to invest into a system. So, our thematic focus at Closed Loop Partners is building the circular economy, investing along the recycling value chain. And, we view ourselves as partnership first and an active partner providing connectivity across the space, making customer introductions, supply chain introductions. We have a lot of sector experts within the firm, and we're also very accommodative in those downside cases because we care about seeing the overall project success. And, we're very much, that patient capital. So, what that ends up looking like in terms of results are, through our history, we've helped support over 700,000 recycling carts being financed. We've kept in circulation, I think we're now over 7 billion pounds of just our catalytic team's financial support. And, we're continuously looking to fund for both private companies and municipalities collection opportunities, MRF automation, new processing capacity, enabling technologies, and even moving into reuse systems, organics, circular manufacturing. And to just give maybe two quick case studies here of catalytic capital in action. One project that there was a lot of press about was the MyPlas LDPE HDPE processing plant that we helped stand up in Rogers, Minnesota, an EPR state. MyPlas, South African company who's coming to the US for the first time, and we said, hey, here's a company that wants to build capacity, let's see if we can help them scale. Well, they ran into some struggles that maybe a US-based company may have not faced, whether it took them a little longer to get up and running, they didn't have as much capital as they thought they needed, and so we were at the table saying when things got tough, we want to keep this going, and all the other partners at the table, General Mills, Schwann's, the Embold Coalition, APW, Charter NextGen, all saw that, all agreed this is valuable infrastructure. There were other creditors at the table who maybe didn't have that same long-term prospect or long-term view that these other partners had, and they had to get negotiated with. We also, knowing the ecosystem, knew the GDB International team out of New Jersey, knew their expertise in processing LDPE, and just asked them, what needs to be true for you all to come in and take over this project? And one of those items was flexible capital terms. So we looked at the capital stack and said, okay, let's amend some of these terms to give you more room and more flexibility to get up and running, secure key contracts, and be successful here. And they just closed another key contract, and they're kind of rocking and rolling in Minnesota and now have EPR tailwinds behind them. And then another one, the city of Kansas City was facing a big litter challenge with their open 20-gallon bin collection program. They wanted to upsize. They had to buy a lot of carts, about a $10 million project, but they didn't have necessarily the budget to do it. So a number of partners, ourselves, the Recycling Partnership, and even Dow Chemical with a resin donation said, hey, here's a financing package that combines low interest debt, grants, and a resin donation. We think this could work for you. Plus, there's the benefit of collecting more material, which we got the carts rolled out, and within the first year, they saw about a 20 to 30% uptick in material collected, which is about 2,000 to 3,000 tons per year. So just in conclusion here, as I've mentioned, a lot of different factors influence the type of investment and how investment gets done in the sector. Catalytic capital, what we have is partnership first, flexible financing that can help scale infrastructure. And overall, I love talking about financial markets and the brainstorming, problem solving of getting projects off the ground. So, if you're developing a project that needs capital, scaling a new tech, going from pilot to commercial scale, processing bottleneck, come find me during the conference. Would love to talk more about it. Thank you.
We have Angie Webb. She works for Maryland Environmental Services. She's Chief Recycled Products and Marketing Director for them, and she's going to talk about recycling markets update.
Sorry, I'm short. Good afternoon, everyone. Again, I'm Angie Webb with MES, the Chief of Recycled Products and Marketing. Thank you again, SERC, for letting me be here and talk about the markets. I know I'm not Chaz. Everybody sees Chaz. They're used to Chaz Miller, and he does a wonderful job. So I really hope that I can fill his shoes. Okay. So first, I kind of feel left out. I don't have any disclaimers, but I will say as my disclaimer, I am not an economist. I sell material. That's what I do. So just so you know, there's not going to be a lot of economics in here. It's going to be mostly just straightforward pricing and talking about what it is. So that's my disclaimer. Sorry about that. Oops. Okay, so I won't bore you too much with who we are. We're a state agency. We're independent state agency of Maryland. We're not for profit. And we operate a variety of recycling operations all across Maryland as well as the Chesapeake watershed area. So some of those operations are MRFs that are owned and operated by the county, certain counties within Maryland. We have compost facilities, landfills, leachate facilities, wastewater treatment plants, and the list goes on and on. All right, so jumping into it, because, I know everybody's ready to start drinking, right? So let's get to it, because I know I am. So let's see. All right, all the pricing that you see here is going to be pulled from recycling.net using the Southeast Regional Average Price, so domestic. I like to do a 6-year snapshot because I think it's really cool to see the ebbs and the flows of all the, over the years of what happens. Like in this, you can see the fluctuations of the COVID years, then the drop post-COVID. So it's really interesting to see what goes on in my opinion. So we have mixed paper in pink, cardboard's in blue. Most people know that mixed paper rises and falls kind of with the cardboard market. And over the last 3 years, we've kind of seen a $30 to $40 a ton gap between the two commodities, which is pretty interesting. So in the beginning of 25, the cardboard market averaged around $77 a ton, give or take, and ending the year at $57. So it's a $20 decrease over 2025. Now from 24 to 25, we saw only a $17 or so decrease. So it was less. We saw a little bit more this time around. But, I'm staying positive that, we'll see it start to come up. Mixed paper kind of did the same. In 25, we started off around $52 a ton and ending the year around 27. And that was a $25 a ton decrease year over year. Okay, so export. Another quick 6-year view of the mixed paper and cardboard export average pricing. I took this from the PPI pulp and paper, yellow sheet, whatever you call it these days. This is FAS New York to Asia, since we're on this side of the world. Again, similar to domestic markets, you can see the ebbs and flows over the last 6 years. Export has showed a little movement, very little movement, it looks, as you can see, most 25, until October. Everybody knows what happened in October when China decided they want to flip it up for us and introduce some restrictions on imported dry pulp. Those new restrictions, what does it do? It causes freaking panic, that's what it does, and it always does. So what happened? Panic ensued, cardboard export market started dropping, but as you see, it's kind of died down a little bit. Things are shaking out, prices have kind of stabilized a little bit, and I think we're going to start to see them recover, which is awesome. So with the export, early 25, cardboard was running around $140 a ton, ending at $113, so that's a huge drop, $27. Mixed paper started around 80 and ended at 80. So there really wasn't much movement. You know, we had some ups and downs a little bit here and there, but it kind of flattened off. It's been, you know, mixed paper has been in good demand, which is nice. So some market drivers, you know, we'll be quick about this. Some of the major forces are obviously the decline in box demand. We've had a lot of domestic mill closures and new capacities, and that kind of evens things out a little bit. You had some old mills that had some upgrades. You kind of need that to happen. The latest winter storm definitely has caused some shortage of material and slow production. I can honestly say for my counties, it's been very, very, very tough having material coming in and having it produced and going out. But we are seeing the imports of goods remain pretty steady, which is nice. So that does mean that the box demand will keep going. I mentioned again, China's dry pulp restrictions have really only mainly affected the cardboard market, which is really nice. We all thought it would affect mixed paper, but we were lucky and it stayed with the cardboard. Okay, plastics. Nobody wants to talk about this because it's really sad. I don't even know what to say. I'm gonna be real. Okay, so these prices are pulled from recycling.net. I like to lump all four together because I think it's really neat to see the different market differentials of the different commodities, which is cool. So everything dropped. Everything just continually dropped all the time in 25. So we have the PET in green. You know, PET is generally the highest volume commodity generated within a standard MRF. And unfortunately, that has dropped really bad, really fast, and is going to continue to do so probably. We've had, as we've mentioned before, a few closures, unfortunately, that has really helped shape and drive down the prices, unfortunately. It's just, and then you have cheap virgin resin. That creates a perfect storm to bring down those prices. So right now we're going into 2026 at around 9 cents, which is pretty low. And we've seen about a 10-cent drop over the last year, which is pretty significant. Next, we have HDP Natural, which is in light blue. Oh, the blue. That is one of the highest revenue generators, commodities within a MRF. We saw a steady decline again through 25, with 26 kind of showing a little bit of improvement, which is nice. We're going into 26 at around 50-cent range, but again, that's a 28-cent drop from last year, if you can believe it, over the year. HDP Color, we got that one in there. That's like a black color, I guess. That one is another low volume, kind of low revenue generating commodity. The market always runs a lot lower than the natural. You can only dye it black, you know, its color. So it can only be used for so many things. Again, another steady decline. It kind of followed the natural market a little bit, which you can see. 3 cents is kind of where we're at right now. And overall, we had another 3-cent drop throughout 2025. So we started out around 6 cents and we're ending at 3. Last but not least, polypropylene, PP. That one's in red. Another low volume commodity. That was pretty flat for most of the year. Pretty steady, which is kind of nice. However, we're starting to see a weird little increase for the first part of 26. Winter Storm Fern affected production in the Southwest, as we all know. We've also had a lot of winter storms here in the East. Some major processes are increasing production, which is helping tremendously here on the East Coast for bringing prices up. So right now, prices are kind of running around where PET is, you know, around 8 cents or so. We've seen a big 5-cent drop over the last year. Okay, some drivers. You know, I mentioned this already, cheap imported resin is a huge cause for the PET market decline, as well as an oversupply of recycled PET. It's just a ton of it out there right now. The processor closures are causing a lot of problems, unfortunately. And construction, I don't know if anybody knows this, but there's not a lot of construction and new construction going on right now. It's definitely down. And that's playing a major role in the HDPE markets. HDPE markets rely on pipes and other construction and manufacturing materials. So if you don't have construction, nobody's going to be buying it. Okay, so I didn't want to do really a graph for plastics export, so I'm just going to touch on a few little things. As you can see, the volumes in 2024 was around 903 million pounds exported out of the US, and that's a 2% drop year over year from 23. 2025 data has not been released as of a couple weeks ago, but preliminary data reflects that, we are going to see another small, maybe 2% drop in volumes. The increase in domestic demand has really kept the export market on the back burner for the East Coast specifically. The West Coast obviously relies much more on the export market due to the ocean freight is much cheaper going overseas than compared to the East. So, I like to say that being on the East Coast, I feel like we're logistically in a really good place to stay domestic and to keep a lot of the materials domestic. A lot of the things seem to be east of the Mississippi where we are, and it just kind of works, so. Okay. All right, UBCs, aluminum cans. Here's a quick look at it. 2022, we see a huge spike, record high numbers, new capacity was aiding in the market increase, which was pretty cool. Since then, the prices have leveled off, hovering just under $1. I know we hit like $1.12 or something last year, which was really insane. And I think we're going to probably hit up to $1.20. I kind of expect it. But right now, the national average is around 80 cents. And that's a 5-cent drop overall for 2025. But I do believe that with the tariffs and because alcoholic beverages sales are down, however, those non-alcoholic fun beverages are rising, it's going to help keep the market steady. Here's steel cans. Steel cans is a little weird one, I feel like. There's never really that much to talk about. We had a 2021 steel market experience, the post-COVID market spike, where there was a shift towards scrap-based steelmaking, played a big role in the increase. And so ever since then, it's kind of stayed around in the higher numbers. And currently, the market is hovering around $160 a long ton. And that's been most of 2025, which is easy and nice. But that's a $15 drop from 2025, like throughout the year. Okay, metals. So I mentioned this already. Alcoholic sales are down, non-alcoholic beverages are up, kind of evens out, which is nice. The tariffs on the finished goods are affecting mostly the steel market. It is on steel and aluminum, but I feel as though it's affecting the steel a little bit more. But because of the tariffs, we are seeing an increase on domestic demand for recycled materials. People aren't shipping it in, so we're having to do it. And that was the point, right? So we're seeing the effects of what the government wanted to do. So with the de-inking grades, I don't trade these much. I know a little bit about them. I didn't want to put, another slide of whatever you call it. I can't even think, sorry. So we're going to move on to de-inking grades. Sorted office waste and white ledger markets are pretty stable right now, which is great. Domestic mill appetites are healthy. Export market is increasing. And recycled pulp is in demand due to expensive virgin pulp. So office waste right now, we're ending at about January 2025 was 110 a ton, and we're about 105, I think, right now. So white ledger, January 2025 was around 195 a ton, and we ended the year at 175. So a $20 a ton decrease in that market. Okay, so sum it up. Okay. Again, I'm not an economist, but everybody knows retail economy is definitely down. We're not buying as much. Unit sales are down. I don't know about you, but there's definitely a shift in purchasing priorities. Consumers are spending more on services rather than goods. Healthcare, childcare. I don't know about you, but childcare is astronomical right now. So there's less money. So let's be real. When there's less cash to go around, people need to focus on their needs rather than their wants. And we're really starting to see that. Okay, so Jason covered really in-depth EPR, which is great. So I'm just going to breeze right on through this. Pretty much just kind of talk about how this could potentially shape the future of the recycling markets. He mentioned, it's a shift in responsibility for local governments and taxpayers to producers and brand owners, which is really great. The eco-modulation is kind of confusing, but to break that down, producers would pay less if their packaging is either compostable, recoverable, or reusable here in Maryland, where I live. And then producers, so like producers that make packaging that don't fall under one of those three categories could potentially pay a higher fee into the program. So there really is an incentive for packagers to make a more responsible packaging. They'll pay less into the program. And the benefits, why? Why are we doing this EPR? Why are states jumping on the bandwagon? And it's to help shape the recycling markets, the future of it. So right now, increase in recycling rates and collection rates. Some of those funds, the point is some of those funds should be used to provide curbside collection of those more rural communities that don't have it and you can't afford to get to there. So if you increase collection, you increase recycling rates for that state and that entity. When you increase collection, you increase the market supply of recycled materials, which is definitely needed as we are seeing the generation is down across the board. And then we want recycling industry infrastructure investments. We want more MRFs in areas. We want to have funding to have better equipment and newer equipment to be able to recover those hard-to-recycle items and create new markets. So I really think with this program, it will start to create new markets maybe for the harder-to-recycle items, such as clamshells. You just never know. But I do believe that that's the point. 7 states, we've already mentioned that, so I'll skip over that quick. Okay, so organics. We're going to go into organics, and this will be the last little bit. So there's 12 states right now with food waste bans. Food waste, food and organics collection is a growing market right now, and it's emerging across the U.S., as you can see. It's a little bit longer list than the EPR. So the New England region, as you can see, is leading the pack with pretty much every state having a food waste ban in place, which is really interesting to see. But, it's going to start creeping down. But why? Why are people doing this? Like, what's the point? Well, the major reason is landfill space. Landfills are expensive to build. There's not a lot of space left, and real estate is at a premium. So the best thing to do is to try to divert as much as you can. So, like, composting organics is an easier one. It's a low-hanging fruit, so to speak, to where it's easy to recover, it's easy to get out of the landfills. Tipping fees are increasing across the country. I know I've seen a couple of different articles come out where everyone seems to be increasing their tipping rates across the country because it's so expensive. Trucking is expensive. Servicing and keeping a landfill going is super expensive. So they're constantly having to increase those rates. And then we have federal policy pressures. That's really causing states to increase diversion efforts. And again, they're picking what's easy. What's easy is getting food out. That's the easy one. Because why? When you compost organics, it not only preserves landfill space, which is what we want to do, but it also produces a nutrient-rich soil amendment that can improve the soil health. It's good for the earth, so it just makes sense to do. And that's it. Sorry about that.
Angie. All right, there's a few minutes left. Is there any questions for our panelists? Yes, sir.
Just a second. Can you share some information on glass recycling?
On glass recycling? We actually have a glass processor right here. She should talk about it, really. But no, on the East Coast, I've seen glass markets kind of raise a little bit. There's been more, like we have Strategic or Sobelco, we have Cat Glass. There are more processors out there now, it seems, that are able to take the dirtier glass. Yes, it may be at a charge, but it does seem that it's a growing effort to divert the glass out of the landfill. And I know with new EPR laws and restrictions, there's going to be restrictions on glass in the landfill. So it is in everyone's best interest to start diverting it, even if it's a large cost.
Good afternoon. First off, I'd like to thank all the panels for showing up on a Sunday holiday weekend. Happy Valentine's Day, those of you who got to enjoy it. Thank you very much. So I want to start with our first panelists. Specifically in Texas, we have so many of these data centers going in, and there's this surge of EPE. Now, we have limited people who will take it. So making it transferable is everything. But it's the way this has just hit the market, this isn't just like a slow little trickle, it's a surge. So my question is, how do we counsel and guide recycling programs? Because this is on the build out. This is what construction there might be, and this is a major offset of that construction, and it has nowhere to go. How can we encourage local programs to take it into their waste stream? Because they're looking at it as like they don't have the equipment to densify it. And even if they did, finding who's going to take it in some areas can be a challenge,
Oh, that's for me? You were the first one. You were the first one.
Yeah.
I was the last one.
I mean, I can answer in context of the states that have EPR, right? Because one of the critical reasons for that needs assessment that a couple of the states have passed, as I talked about, a couple of the original states did start with that, is to create, actual operational mechanisms to solve for those local problems, right? And that, one of the things I think when I'm doing presentations in EPR, and it can be confusing, and everyone questions why is it all over the map, because at the end of the day, sometimes it's done badly, sometimes it's done well, it's designed to improve and solve challenges at the local level of recycling infrastructure, right? So I feel like I'm dancing around the question because there's just a lot of specifics involved with that, but if EPR were to pass and were to have that needs assessment, there's like a year, 2-year, 3-year process in place to go down to all local municipal and private waste haulers to find out what it is, how can they improve recyclability, what operationally has to happen, what sort of technological improvements have to happen, what sort of access to markets have to happen in order to have those things get recycled. And it's happening in Maine right now. That is part of what's sort of delaying this process, is going around from municipality to municipality to figure out what it is that they're really at the local level having really a hard time recycling. Does that kind of answer the question?
So this is the packaging that comes on these giant motherboards we're putting in this massive data center.
Yeah.
And so it's not going to be a continual stream once that data center is built out. But for the short term, for the 12, 18 months that the center is being built, they're going to have this onslaught of this EPE, and then they won't have anything. Or it's going to move to another location where the next build-out is going to happen. Now, where EPR is concerned, who would be responsible for that packaging product? The one who manufactures the motherboards or the RAM? How do we, because these smaller systems have no idea even where to take this concern to, where it would fall.
Yeah, likely the producers of those motherboards are going to be the ones. And this is a very generic answer, but generally speaking, it's going to be the producer, the brand that has to pay into the system. And that's regardless of whether it's an ongoing concern, something that ends up on a consumer shelf, or to your point, if it's tied to these huge projects, but it's kind of one and done, so to speak. Now, the trick to that is Colorado would probably not pull that in. What you're laying out would be outside of scope because we're so focused on business to consumer versus business to business, versus a state like Oregon, California are pulled in. So you can have those differences at the state level as to whether or not they're anticipating, sort of the commercial end of the recycling and waste efforts that are going on. But if there's an EPR bill in place, and if it's extended to include business to business, then whoever's putting that in the system is the one that pays the bill.
Which state are you talking?
Texas.
So
you
in
can't tell
Texas.
y'all. Come on.
So far away from having an EPR law.
Yeah.
So is the product recyclable?
Yes, the EPE is very recyclable if you densify it, and I have export markets that would be open to it. But for a small area to invest in that machine, literally for maybe an 18-month surge, isn't logical. So then you have to find some kind of interim there for the shipping of that product to who will buy it, as everybody's found, and it's just, it ends up going landfill, and it's horrendous. And tip fee or not, it's light. And in Texas, our tip fees are horribly low, so. But thanks, everybody. I'm Gigi, if you don't know, but thank you. It's going to be a big concern with what's the projected build-out in Texas of the data centers.
All right, some more questions over here. Here comes the microphone.
I'll be right with you.
Hi, Marty Seaman with RRS. Hey, Ray Hugel, can you talk about the imbalance or the time imbalance on the investment cycle? I represent tons of packagers who are on 3 and 5 and 7-year design and innovation cycles, and we have 20-year MRF facilities or 15 or 30-year facilities. And how do you guys kind of address that? You know, you're talking about there's more capital needed, et cetera, but to me it's, and we're going to need it again in 3 years and again in 3 years and again in 3 years. And how do you address that kind of, you know, changing of the packages themselves? We're changing much faster than the investment is. It's true with trucks too, or any number of things, but I guess specifically in the facility space.
Yeah, it's a great question, especially, even one of the, make sure I'm close to the mic here. One of the themes Angie mentioned on more OCC in the system, right? It's like, that's not even product design, that's just different type of product being used. So, I think it's a little bit about, well, one, if I'm financing, MRF equipment, I'm thinking about it from a 5 to 7 year cycle, and can things get repaid then, knowing that that's generally the upgrade cycle, which means, municipalities that are maybe borrowing 10 to 20 year money and thinking it's a one and done, it raises this question, okay, well, now they're, for lack of a better term, in the Stone Age with their MRF, and they're 2 cycles behind, and can we find other sources of capital to get them upgraded? I think maybe that's a partial intention of EPR, to have money in the system from the brands to go towards that continued build out. But then the other one is, finding alternative sources of capital, whether that's at the federal level with grants, what we do in our capital, but municipalities are sometimes constrained on what they can access just through county or state level statutes. They can only do bonds without a countywide or statewide vote. So, I don't know if we've solved it, but it's more just trying to find new tech that can do more than one thing. I think about it as and Mark, maybe you could talk more about this, optical sorters, just being able to shoot on different material types can help solve, if that's where you're getting with.
Through a retrofit or something.
Yeah.
Even you saying that you're looking at 5 and 7 years, lots of folks are. They're looking at 10 or 15 or so. You guys in Maryland, you're looking at that. Much longer cycles than that. That's the challenge.
And I think it's why you've seen a lot of maybe the robotic companies also start focusing more over the last 2 years on the data angle as well, to why we invested in gray parrots now 4 years ago was because nobody at the time had just the vision system, or they were just getting there, because their whole pitch was, we can tell the MRF to slow down or speed up the belt to better capture, and with that data source you can change based on a changing stream.
All right, we got questions, sir?
Yes, good afternoon. Thank you for the beautiful presentation. My name is Steve. I have been in the plastic recycling business for 41 years. And my question is about EPR. So Jason, I want to know that in the U.S. we have some states, they enforce EPR systems. But then at the same time, there's also other states that they don't enforce. I don't know technically how this is going to implement. And also my next question is, because we cannot afford not to talk about money when we are in the recycling business, especially what Angela just mentioned about the plant production is over capacity, and also it's very, very cheap. So I just wonder, how did they enforce especially just now the lady mentioned about EPG. I think these are recyclable and also very good demand, just matter of how you implemented it. And then when we talk about like different kind of plastic, including EPS or packaging, when I talk about packaging, we have PE film, polyethylene film or polyethylene or polypropylene. You know, we face problem of like when you talk about extended producer responsibility from oriented or from supplier or from wholesaler. So how this going to be implemented? At the same time, when we source some material which imported, I don't know whether Angela also post some imported material or not, but I saw there's some export, but they also saw some imports. So how could they implement a policy on some of the material from the producer or from the supplier which are imported? Yeah, and at the same time, we also think about the brand owner. So when they have to use recycled content, so how they're going to differentiate this is from this state, that's from the other state, this is sold to other state that there's no EPR system. So I would like to see the economics of it, if there's some implementation, and how to implement it. Thank you.
Yeah, I mean, a great couple questions in there, and you know, as far as how it's going to be implemented, we're seeing now, right? This is very, very early. And so, as I said, Oregon is the only state at this point that has actually gone through the first cycle of having producers report and pay. So there's funding now. And so they are taking action as we speak to open up more drop-off centers, for instance, to make it more accessible. Multiple things like that, right? Because when we say that the point of EPR is to help address the challenges at a local level with recycling infrastructure, one of them right off the bat are these sort of recycling deserts, places where the average consumer doesn't even have access, easy access, I should say, to drop off their recycling. So the implementation is going to be very, very challenging, and this is the first state that will actually, where we can watch and see and learn what works and what doesn't work. One of the big issues and challenges that I think I heard threaded through your question is how is this going to be effective when it's every state doing that in its own, having their own mechanisms, their own goals, different infrastructure, and then having all these other states that don't have it. When everyone in this room knows that waste and recycling doesn't stay within state borders, right? One of the questions I get asked a lot is, okay, when is this going to be a federal program? And I'm like, don't hold your breath. You know, given the political situation right now, to conceive of a federally driven EPR for packaging set of rules is kind of Looney Tunes, right? So one of the things I think that is a first step that can happen, and when I talked about, you know, sort of these zones where states that have EPR tend to then, you know, create other states around them that have EPR for packaging, is if we look at the Northwest in general as a recycling infrastructure, recycling chain, if we look at the Northeast, if we look at the South, if we look at the Midwest, there, you know, I know from my background in waste and recycling in Bottleville that you have these regions where you've got recycled material being collected, transported, you've got, you know, it being processed to be the feeder material for other recycled products, that kind of thing. So if at least regionally states can start sort of pulling apart the boundaries that are stopping it and work cooperatively among that, I think that'll be a huge step forward. There's discussion, there's no regulation yet, there's discussion about that happening. The third piece is really, this is the challenge in all of this, is plastic. And so, you know, you've got at the local level all kinds of programs that are extremely, especially after Imperial Sword and all the things that have changed in the recycling landscape. Now with tariffs, all of that changing. You've got all kinds of areas within a single state that can't, they're only recycling the stuff that makes them money, right? The rest of the stuff's either being stockpiled or worst case, they're turning it away. The states that are doing this well that the money that the brands are paying into the state is designed to help that infrastructure to improve their ability to recycle more difficult to recycle materials. The states that are being more prescriptive about it, like California, basically what they're looking to do is ban a lot of these plastics, right? And let's just face it, that's part of what's built into EPR. So I think that this is where the real challenge, and I think if I were to look ahead at what some of the next lawsuits might be about, is this focus on plastic. So I know I'm not answering your question necessarily, but these are, you're asking all the right questions. That you know, the implementation, the lack of state-to-state harmonization, and then really no one quite having a great answer about how to handle plastic is at the core of all of these things.
All right, any other last questions? A couple more in the back there, and then we'll wrap it up.
I've got maybe a quick one. On EPR, specifically in California, maybe in Maryland as well, but how does it deal with exports? Because I do feel like there has to be some legitimate recycling outlet market that can be proven, so export makes it a little grayer. So with the lack of end markets that there can be with some of the plastics specifically, you're just going to generate more of a problem. And I just wanted to hear what the kind of verification could be.
Yeah, I don't know if Andy wants to talk on Maryland, but you have in Oregon, for instance, and most of the states have a variation of this. One of the multiple requirements is that it goes to a responsible end market. Responsible as defined by the state or by the pro in that case. So if you're not able to prove that it's going to a responsible end market, you do not get to designate it as recyclable. And taking a couple steps back, and this is actually another part of the answer to the previous question, what the covered material category fee registers and then the eco-modulation programs behind it on the malice side, what they will end up doing, what they're designed to do, is make it so expensive to put a type of plastic or any other kind of packaging, but let's face it, it's plastic we're talking about, into the state if it cannot be recycled, if it can't be proved to be going to a responsible end market, that effectively a brand will, the idea is they'll stop even using it. That's the, is there something specific about?
No, I mean, you covered it. That's exactly what it's for. I mean, a responsible end market, as long as it's within those guidelines, then that's what it is.
One more.
Hi, I work for the University of Tennessee Recycling Program, and over the past few years we've seen, we've gone from a pretty small program to heavily relying on the MRFs in town to becoming our own sort of mini MRF in terms of the more profitable material. And you mentioned EPR in Tennessee itself. What's the outlook on that? And as we look to expand, we would like to get to the point where we are no longer reliant as a university on companies like Waste Management or the local MRFs and kind of run the trash routes, we already run our own recycling routes, but doing that all in-house and be able to be responsible for everything that leaves the university. So how could we position ourselves for whatever the EPR outlook is in the state of Tennessee?
Yeah, I would say I mean, it really is, it's an impressive bill. And I think that, I could be misstating this, but I believe that really what happened last year is the clock ran out. I think your legislative session ended before they could get a formal vote on it. You've got some, I'm telling you, you got some zealots, there's a better word than that, that are out there just doing tremendous advocacy work for it. And so to the extent the university has the bandwidth to become an advocate, to get in front of your state, your local politicians and keep pushing. Again, just my editorial, but it is, I think, really written well, designed well, took a lot of learnings from the other states. And I honestly believe it's designed to actually, if implemented correctly, will create jobs. So, again, speak to your local, your local politicians, your local representatives, and keep pushing.
All right, well, let's again thank our panelists for a good discussion. And welcome reception is in the exhibit hall.